I'm Doug MacKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Happy Friday.
Oh,
How you
good.
doing, John?
Happy Friday, yeah. I forget that. Yeah. Is it Friday? Oh my God.
No, it's not, but this is going to be released on Friday, so I'm
that. Blows my mind. Great.
Yeah.
All right. Yeah. Well, happy whatever day it is you're listening to this, everyone. I want to say right up from the outset, I want to thank a friend and an avid listener to this podcast. Sending me a message yesterday and then taking a couple of minutes to talk with me. And it's something I've thought about. I shared with you, Doug, we've now done 40 plus episodes, and, I listened to the ones early on, but I didn't really go back, in the last number of months. I haven't gone back, but I did yesterday. I started listening to, what is infinite banking, because this friend, shout out to Kevin. Thank you, Kevin. Really, really appreciate it. Is that he shared the podcast with his brother. And, his brother's very sharp. It's not like, he just doesn't really understand a lot of things. He understands a lot of things. And after he listened to that episode, or maybe another one too, at the beginning, the first couple episodes, he was left not really understanding what infinite banking was. And again, I should keep putting the word concept at the end, right? Because it's not just infinite banking. What is infinite banking? Well, it's a concept. And it's a concept that can be turned into a practical reality, but you need to wrap your mind around the concept of it, and then do what you understand with the rest of your life and your knowledge, and it'll make more sense, hopefully. So we're going to try to revisit, it's infinite banking concept revisited. This episode's going to be about. So.
Yeah, because in our show name, the ABCs of IBC, we figured it was a good time to just kind of go back to basics. I know that when I was first trying to wrap my head around this whole thing, I had to really listen. I listened to a lot of podcasts. I read a lot of literature and a lot of books. And it took me a while to grasp this, just because it's such an unfamiliar concept, and it is very different from any sort of traditional financial medium that people are familiar with. So I think this was a great idea. Thanks for bringing it up, John.
So I want to say, to add on to what you just mentioned, which is, I didn't really think about this necessarily as somebody would just refer a friend, a family member to the show, and they would have no background, right? Like most prospects come to us with some knowledge, right? But now when we're doing this, this is the very, very beginning. It's their first introduction, other than a conversation with a friend or family member, which of course they're referring them to this podcast because this is going to be, maybe a way that they can wrap their mind around it beyond, a short conversation. So I want to start, and trust me, when I start to say something, please interrupt if you'd like, or join in, Doug. But I know that there's going to be a need for a definition even beyond that, right? So hopefully we'll stack it a bit in building blocks of understanding. Okay, so the infinite, for me, if it's okay to get going. For me, the infinite bank.
Yeah, go for it. Let's start working through it. And we've actually prepared. Well, I should say John has.
Yeah, that's
more
true.
than we do for most episodes. So
the infinite banking concept, it is the creation of your own banking system. Okay, so when we say bank, it's not the physical bank. It is the concept of the banks that we understand, right? And so the concept is the key. And if you understand the very first principle, that you are either paying interest to a third party lender or you're giving up the earning of interest when you pay with your capital or your cash, you'll understand this better about what this really means and why you would even consider creating your own banking system.
So I think we should dive in a little bit again into that first principle, and then also just really highlight exactly what you just said, which is that the infinite banking concept is about creating your own banking system and replacing, ideally, eventually, the traditional banking system function in your life. And I think a lot of when you read or see a lot of the things out on social media from like non Nelson Nash practitioners and not affiliated with the NNI, there's a lot of hype and noise about the infinite banking concept, and most of it has nothing to do with that core principle. It's just about like, hey, you can just slam as much money into a policy as you can. You could, take it. It has nothing to do with that. It is, like John said, at its core about taking control of the banking function in your life. And then I think that it would be really good if you could delve in a little bit more into that first principle of either paying interest to someone else or giving up interest that you could have earned.
A slight diversion from that for a second, that this is really creating a business. When you create this, you're going to start a bank, in essence, your own bank that you could use for your own life or for others. But whether you're using it just for that, and that's a lot, or you're a business owner in some other business, right? Nelson says that businesses come and go, but banking is eternal. I think it's the word he uses, right? Which it's forever. There is a need for somebody to play the role of the banker and the banking function in our lives. And so you can be that banker. You can play the role and to create the banking system within your life and beyond you, right? So you're going to either typically finance things in your life through outside lenders, and they will lend you the money, but they want you to pay them an extra payment of interest when you pay back the loan. And so you're either going to be doing that, and most people that are probably listening understand what it's like to take a loan and pay back with interest. And if you decided that, no, I'm going to save my money and then I'm going to pay cash for the things that I want because I don't like debt. You hear that often. Well, when you take your money and give it to somebody else for whatever reason in exchange for something, you now have taken that money off the table of ever being in your life again. If it was in a place where it was getting some sort of return, rate of return, interest, then you won't get that interest. And you also won't get any of the interest that money, that interest was making, and compounding, which we've shared many times. But this is trying to build the blocks here.
And Nelson, I mean, so, and again, for any people that are really new to this, we would always highly recommend that you read Nelson Nash's book, because it's kind of the cornerstone of all of this. And he uses the example of car financing, I think, because almost anybody can relate to that. Most people have bought a car at some point in their life. And I would say the most common way that people do it is by financing it, of course. And everybody's familiar with that. You either, you get like a loan directly from the dealership or from a third party, and you're going to pay typically simple interest, but sometimes it can be amortized or have other things in there. And so you're going to pay a set amount of money on top of what you would have paid for the car to the lender. And so you have that money is flowing out of your system. And on the flip side, if you opted to save up, let's say $20,000 for a car over, 4 or 5 years, that would be viewed as a very financially responsible move by many people. But like John was just talking about, you might be able to earn, let's say, even now in today's environment, if you were to go get like a high yield savings account, you get 4.5%. So the second that you go take that $20,000 out and deplete the account, you're never going to see that money again, and you're earning nothing. And so what Nelson points out in the book is that the net result,
Doug,
is actually
can you say that again? You did cut out a little bit
between the person that finances and the person that saves
last
up.
couple of sentences, yeah.
Oh, the net result is that the person that finances and the person that saves up and pays in cash, it's really the same end result. You're really having the same amount of money flowing out of the system. So like in the end, the person that saves up and pays in cash is not really yielding a long-term better result, which is kind of goes against what most people would think. And I think typically the person that saves up is going to be more financially disciplined. So they're probably going to, have a better, more conservative financial outlook. But in the end, you're still left with all that money flowed out of your system, and so you've got nothing
hopefully
to show for the $20,000 that the car cost.
Which is the idea that if I pay with cash, hey, the reason I'm doing that is because I don't want to pay the interest charges, right? I want to not owe somebody something, right? Have debt. But I'm not going to pay the interest to this outside lender. And that is the crux, is what we're saying is, well, that's why it's not really better to pay cash, because you've given up the interest and the compounding of that interest. And if there was ever a way for that to never get interrupted, that's going to be a lot more significant than the savings that you have from, not paying interest to an outside lender. Yeah. Okay. How about now? Any better?
Yep.
Okay. I don't know what that is.
Yeah.
Okay.
I mean,
we'll just keep continuing. I feel that is the big thing, right? But I want to go back to the first thing I said, which is this infinite banking concept is about the creation of a banking system. So I think it's important to understand what is a banking system. I don't think in terms of creating banking systems. Why do I even want to create one, right? Well, because of, first of all, the fact that you finance a lot of things. Cars, as you just mentioned, and houses and all kinds of things, right? Yeah, all kinds of stuff.
Houses, home improvements. I mean, yeah, vacations. People now with the advent of buy now, pay
Yeah.
later. People are financing
Yeah.
so many
Klarna,
like people
or something,
finance just
was one of the
$200
companies. All of a
purchases that they
sudden,
make on
yeah,
Groupon
you
now.
just
It's
want to pay,
crazy.
you're going to buy something for $120, and they're offering to finance it for you for,
Affirm, yeah.
for 4 months. Yeah, exactly. And so I want to just break
Yeah,
down
make
what
4
I
payments.
believe the banking system is,
Yeah.
which is a warehouse of capital that can be lent out and turn a profit via interest charges. It can be lent to you and, say, your family, or you can lend it out to others. So,
Yep. Well, and the whole crux of what you just
yeah,
said is that you
yeah.
can do whatever
And
you want with it. You have
as I like to
control.
say, with some basic banking rules, you're not only going to bring the capital availability back into the system when you're making payments or somebody else is making payments to you, but you're also earning additional profits by charging yourself or others a retail interest rate. And Doug, this has been a bit of an epiphany. Well, it's interesting because I've mentioned I have my brother
Let's hear
Ray
it.
is also an infinite banking concept practitioner, authorized. And we were talking about a week ago, and he was like, I don't understand why I never got this, really, right? Which in the book, everyone, Becoming Your Own Banker by Nelson Nash, he uses a few different analogies. He's all about analogies, and the understanding that there's certain customers in a business that are captive customers. They're people that want to do business with you, which actually includes yourself. If you own your own bank, you would expect that your spouse, that your children, that hopefully even just everybody that likes you, hopefully your extended family and friends, right? So respect your capital's value, right? Its economic value. And so it's hard to bring somebody from the beginning and not like keep going forward and backwards. But the idea that you can borrow from your leverage your capital somewhere, which we'll get into, and then pay somebody else interest when they lend you the money. But when you pay it back, you're a captive customer. So I'm going to pay myself back at a higher rate. So I'm basically wholesaling the financing and the charges from that lender, but I'm paying back at retail. And when I pay back at retail, I'm paying at a higher rate. I'm either able to, well, in some form, I'm going to save because I'm going to pay off the loan that I have faster. But don't stop. If you say I'm going to take a loan for 4 years and I'm going to pay, at twice the rate that I'm being charged by this lender, keep saving, keep paying, making that payment for 4 years, even though it only took you 3.5 to pay it off. So it's forced savings.
Well, yeah, and then when you get to the point where it's the loan's paid off, that's when you get to the point of perhaps opening another policy, right? I just don't want to
Yeah.
create any
Well, yeah,
confusion
and
there
that's the
because
point,
sometimes
right?
people
This is
think that they
where
can pay more
hang with
money
us
into a
if you're a
policy
new
than the
listener,
space allows, and you
because
can't do
now
that.
you've heard
So,
policy.
do you know what I mean?
And if this is your very first time, you don't even know what we're talking about. Right.
is that right, exactly. But the beauty of this is that instead of either paying someone else interest or saving up and then making a lump sum payment for something, you have the ability with implementing the infinite banking concept. It's this idea that you can essentially have access to your money without interrupting the compounding process. And so it's this, and again, it's a very simple idea, but it took me a really long time to grasp the power and the beauty of that. So I can have this growing lump sum that's never going to get interrupted. It's just going to be there for the rest of my life, always going up, never going down. And the amount of leverageable capital that I have is always going to be increasing, and I can just constantly cycle in and out of that.
But that
Does that make sense,
essence,
John,
right?
what I just said?
That we never interrupt the growth of this capital pool. It only grows. And that allows us to do ever more banking.
Exactly, and that's what banks do. Banks lend out
Absolutely.
money to make money, and they have stores of capital
starting
that
out as
aren't
a bank,
depleted in doing that. And so essentially what we're doing,
you can't lend more than you have, right? That you only have so much capital. But through the banking process of lending and then receiving the return capital and a profit on top of that, and then do it again, and then the money comes back again with profit, obviously that pile continues to grow, and you can finance things for yourself or others that you could never have financed at the beginning of the process, right, of building this banking system. So it only grows. Now, just like a banker, you're going to make prudent decisions in when you're borrowing, that you have a means to pay it back. And if you happen to lend it to others, family members, friends, people in the community, I mean, if this became big enough, you can do all of this. It's not just myopic. It's not just you. It's not just your family. It's thinking about this is actually getting into the banking business. And you are one of the customers. That's the easiest way to try to just, okay, it's just me and my family, and I want to be able to do it. But boy, look at this. I can serve others and continuing to build my banking empire, which can go on for generations.
A very thing you can do. Yeah. Oh, absolutely. Yeah. Yeah. This is a legacy creation as well, and we've talked about this in other episodes. And it's a very unselfish thing that you can do for your family. Continuing on for a very,
making
very
some
long
progress here, because I can continue. Okay, so as I said, when this capital keeps flowing out and returning with a profit, just like
continue, please.
The physical banks, commercial banks that we're used to, we can create a system of branches of our bank. And that's because, hey, we want to cover more ground. We saturated this this branch, we've got what we expect is the most amount of customers, which is the most amount of capital to keep going in and out. And then I decide that I have all these profits. Let me go across town and open up another branch, which we're going to get into in a moment, because we did mention that this is a policy, a life insurance policy. So this branch is another policy. Again, I'm just trying not to, like, you're trying to cover it all. Okay, so let me say that, okay, so how do you put this infinite banking concept into practice, right? You don't actually, again, it's a concept, but the analogous to creating a physical bank, or the banks that we understand, whether it be an online bank, it doesn't really matter. You don't have to go through the process of getting what they call a bank charter from the banking commissioner. You don't have to go find a location, a suitable building, brick and mortar. You don't have to hire employees. You don't have to advertise to, hopefully gain deposits from your customers. You don't have to do all that. There's actually an easier way to do it, and this has been around for over 200 years, and that is what is called a participating, which means that you receive dividends through a whole life insurance policy. Well, we are the owner, part owner of
now
this insurance.
Why do we want to use participating policies,
or an
John?
agreement with this insurance company? So we want to be in partnership with them and receive growth. We want the growth. We want the dividends. And we also want to be in business with somebody that wants to make good decisions. And that's really where we're at. We're making good decisions with somebody who's already built this system, that's already built this whole infrastructure.
And that's more financially sound, than almost anybody out there. Just a quick distinction. There's also, there's stock-based insurance companies that do sell whole life insurance. They could theoretically work just fine for practicing the infinite banking concept, but you're never really going to see anybody implement a policy with a stock-based company.
They're not all the same.
Especially an N&I
all
practitioner.
Life insurance companies are not the
because
same.
Their primary obligation is to stockholders, not policy owners.
What I just described,
distinction if you see that.
Arduous process of creating these commercial banks that we're used to out in the world, these insurance companies have already built all the infrastructure. They have the physical place. They have the employees, right? They've already built all the pieces. And what you have to do is plug into that system and plug your capital dollars, your cash flow into the system. It's like you're becoming, a franchise of this big potential banking system, but you run your own franchise. Is that going crazy, Doug, or what are your thoughts?
No, it makes sense. I mean, it is very similar to a franchised business. Like, let's say you go and open a Subway, right? You buy a Subway franchise, you immediately have access to all of their corporate level resources, their marketing. They're going to tell you how to set up your store, how to make the sandwiches, how to do all these things. So, like, when somebody opens and applies for and gets a whole life insurance policy, you're immediately plugged into that. You don't have to do anything. They're making the decisions on how to allocate the premium dollars. They've been doing it a very long time. They're very good at it. And so you can, I mean, I don't really know of any places that more conservatively and effectively manage money than
And
mutual life insurance companies. And so I'm very comfortable being a part of
it's been a
the
long
companies
time
that I
I've
have
said
policies
this,
with.
they are probably the smartest.
I mean, their track record is really second to none.
They're not gamblers, right?
No, they're not. And even in periods of extreme downturn, when you see very large companies that, are worth like a ton of money just absolutely shitting the bed, these guys just keep plugging along as if nothing's going on. It's slow and steady. I think a lot of people kind of miss the beauty of that at first because most people are really looking for that instant gratification. But this is a slow and steady race to build a series of, just like you said, bank locations. And most people that we work with wind up having more than one policy because when you're really implementing this and when you're really plugging into this system and utilizing it correctly, you wind up having the need to expand. And it makes it very easy to do that, just like what you said before. I mean, and Nelson talks about this in the book, but to actually go and open a physical bank is a thing. I mean,
Nelson
even to get
says,
the charter license can take can take decades, and then
to go through
obviously
that
a lot
process,
of overhead and capital and regulations.
Why
and
do
this
people
makes
go
it
through that process to
very easy
to get the bank charter and to do all those steps that we talked about earlier? It's because it's a profitable, very profitable business. And he said somebody's got to serve the banking function in your life. And what he's saying is that it should be you that serves that role.
Absolutely, because the banks make just an almost like an inconceivable amount of money, especially when we get down to um, fractional, lending. But why wouldn't you want to? Why wouldn't you want to replace that, and you can make the money instead? I mean, if a bank is giving you what seems like a good rate of return right now, let's say you find a savings account with 4.5% or 5%.
For a second and talk.
They're making far more than that on every dollar that you put into that account.
Things like,
I guarantee you.
Well, yeah, but banks can
far more
do this, and banks can do that, and banks can close and get taken over because they're not doing well, or they can be closed, like Silicon Valley Bank was closed in March, right? So we're talking again about the concept. And when you're conceptually thinking about it, think about a bank that will not go out of business, that will not have to close its doors because their capital does nothing but grow. And they, in this bank that we're talking about conceptually, when implemented, right, will never lend out more than what they can handle. So whether this bank, your banking system, lends it to you or lends it to someone else, You will never overstep what you have available to lend. You will not be overextended. And when we make prudent business decisions or banking decisions, whether it be for us to pay it back or whether we're going to have, return of capital and interest from someone else, we are always going to be growing the size of this bank. We're going to have more and more and more capital, and we just keep letting the money flow out and back in again with a profit.
Yes. And the access to money is, if people can picture like a HELOC, home equity line of credit, it's very similar to that in that it's the money's available, but it's the way that it's dissimilar is that line of credit with the insurance company is always growing. So like I have a HELOC and it's fixed and it's going to be fixed forever until it expires or unless I want to go pay to get another HELOC. This is growing every year. Every year that I make premium payments that the company shares in its profits with dividends, my line of credit is growing. And it also it can never be called. So there is, just like you spoke about, there is no possibility that I would not have access to that money. My bank locally could tell me that they're not going to, honor my home equity line of credit anymore. They could do that.
That's a big difference, right?
The insurance company will never do that
because banks,
you're contractually guaranteed to have access to your pool of capital.
They decide
without questions asked.
They have different lending criteria.
It's a big difference
at various times, or they're disinterested in lending in ways that they may have been in the past, but with economic changes, they will honestly say, I don't want that kind of business right now. And even though supposedly you have quote unquote money in the bank, this home equity, the equity that sits in you cannot access it because they are in control. What you're doing is you're taking that control for yourself. And that is very big.
Yep. Nelson talks about it. Those who have the gold make the rules.
And the gold is the capital.
About allowing people to kind of have control of their own financial destiny.
So that's, that's the crux of it. And I do want to encourage, like Doug does often, is to read and reread like Doug and I do. And revisit. Nelson tells a lot of good stories in Becoming Your Own Banker, which he subtitles Unlock the Infinite Banking Concept. Unlock it. It's available to us. But he tells a lot of stories that sometimes it's hard to tie it all together for people. And that's why they're almost individual concepts of the bigger concept. Each story is its own micro concept. They all, the sum of their parts, do come together to be what this infinite banking concept is, and it's a way to express how you can implement this banking system in your own life. But he uses the idea of, if you're going to borrow from somebody, always pay more for that capital, because that is a forced savings. If somebody's charging you 5.5%, charge yourself 11%. Again, like I said earlier, let's say you had agreed to take it out at 5.5% with a commercial lender, and you decided, I'm going to pay the going rate. We know what those payments are, but let's say I'm going to pay it back at twice that rate. I'm going to pay it back at 11%. That means, and I'm just throwing out numbers, that means that you've paid this off in 3 years instead of 4 years. But if your payment is, let's just say it's $300 a month, keep paying. There might be room in your policy to accept it, where you keep paying the $300 for that final 4th year. So 12 payments, you've just paid $3,600. If the policy can accept it, then you put it directly into the policy. Or you put it into a side account, which then when you're ready and you decide where you want to put this new branch of your banking system, which is a new policy, and who you want to put it on, yourself, your spouse, your children, some other person of interest to you, then you have the capital to start that next branch. That's technically what he's talking about when he says you can pay yourself back the interest.
Mm-hmm. Yes. Thank you for clarifying that, because I see that get twisted a lot. So you are paying back interest to the insurance company, but you are benefiting yourself because you then have access to that line of credit again. And so it's kind of a rinse and repeat process. That was really well said, John. If I could just add one last thing before we kind of finish up for the day. I think a lot of people, when they hear about this, they think it's kind of, okay, well, if I do this, then I can't do that. Or if I'm going to practice the infinite banking concept, then I can't be putting my money towards real estate or in the stock market or in my business. And what we're trying to say here is that you can do both. You can do anything that you want to do. This is about putting your money first into your own banking system so that it doesn't leave your system. Like, you are always going to have access to that dollar that went into your policy. And this works really well in conjunction with whatever thing that you want to do in your own personal life to make money outside of the policy. Whether that's financing something in your life, whether you're a real estate investor, a business owner, stock market investor,
prudent decisions.
This is something that you can do in conjunction
because
with that. It's not an either or type of thing.
Sorry, Doug, is that you have a confidence. This brings a confidence to your financial decision making, right? You can do all the things you just mentioned. You can do other investing. Because even if I don't jump on this opportunity, it's not because I've got to make, some returns. You already have a place where you can create returns. When you do the financing of things in your life or others, you can honestly already receive a rate of return because you can pay yourself. And then I can do more and more and more. Do I have to do more and more and more? No. But you have all the control. And that's huge. And that's why you called your company controlcapitalsolutions.com. Yeah.
Yes, exactly. Yeah. That was the thing that always stuck out to me the most about this that I really like is having control. I mean, even something as simple as taking a policy loan,
Awesome.
it's so easy, you know, it's fully within my control. But yeah, John, thanks for putting this together. This was great.
Try to clarify it even more.
Questions on this, we welcome that.
Yep.
So,
and I'm sure it's the way we
doesn't know what we're talking about, let us know.
We think. So, yeah, we're happy to try to figure out how to always get the message across, and then let people decide on their own whether it makes sense. At least they'll understand it conceptually, right? Thanks, Doug. Really. All right. Until next time. All right, buddy. Have a great day. Thank you. Bye.
Exactly. Thanks, John. Till next time. Bye. You too. Bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.